Today's video is on a topic which is a favorite of all our investors and YouTube subscribers, and that is alpha. In this world where you see so many investment managers and so many investment strategies, everybody talking about their own unique philosophy, who is the one who will be able to generate consistent risk adjusted excess returns for you or alpha for you? Is that even possible? Can an active manager generate alpha? How consistently can they generate, and how long does alpha stay in a strategy? These are some of the questions that we will try to answer in this YouTube video. Obviously, there is a little bit of statistics and a mention of financial theory that is there in this video. And what I'll try to do is simplify this for our subscribers. Now, talking about financial theories, right? One of the most popular financial theories and one of the oldest, efficient market hypothesis, what it says is that markets are efficient. Everything that is to be known about a particular stock or a portfolio is out there in the market. Right? The market price knows everything. And it is extremely difficult for somebody to outperform the market based on the available information. That is what the efficient market hypothesis says. And if you were to beat the market, what you really need is either some sort of insider information that gives you that edge, or you should have a forecasting model that is able to forecast what will happen into the future. But we all know that forecasting into the markets is extremely difficult. I'm talking here with my experience that market prices are extremely noisy. And if you try to forecast prices, it is an extremely difficult task. There's a very popular saying as well. There are two types of forecasters. One who knows that the forecast can be wrong, and second one who really believes in his forecast, and the second one is a dangerous investor. But of course, if you look at your experience investing into our momentum strategy, you would have seen consistent outperformance coming out of that strategy. So how is that possible? The answer here is that there is a lot of bias that is there into the market. There is an overconfidence that come into bull market. There is underconfidence that after a correction. And those types of biases let investment managers take advantage and generate alpha from the market.
Alpha is everywhere. Let's try and understand what we mean by this. Let's look at a very simple example. If the benchmark or the stock market is giving a return of, let's say, 10%, there might be companies out there that might be earning much more than 10%. And what does this mean? Well, this means that if that is the case, then alpha does exist. Let's look at some data. Here you can see companies from S&P 500 between the period of 2013 to 2017, and in most all the cases we can see that there is a presence of alpha. In 2017, the S&P 500 gave about 21.8% return, while there were 214 companies that outperformed and gave about 42.3% on average returns. Similarly, we can see the case in 2013, 2014, 2015, 2016, and I'm sure we can find such examples across the board in different sectors and geographies as well. Here's an analysis that was conducted on the Russell Index of the large cap, the mid cap and the small cap sectors. And what we can see here is that if they created an equal weighted portfolio of the best performing stocks and then they created an equal weighted portfolio of the worst performing stocks, this is kind of what we see. We see that alpha is present and is prominent with noticeable spreads between the best and the worst performing stocks. It is more pronounced in obviously the small cap and the mid cap segments. The only challenge ultimately remains for us is how do we identify and select the winners from the losers. Despite alpha's evidence, are investment managers able to find it? Let's look at the alpha generation across large caps, mid caps and small caps. For this, we'll look at a research that was done by CRISIL for the Indian equity markets. They considered the period from 2005 to 2021, and they considered the average rolling period alpha that was being generated by these actively managed equity funds over this duration. Right? And as you can see here, the 5-year rolling period average alpha generation over this 15 years, we can see a significant underperformance for large caps and also for mid caps and small caps to a lesser degree. Let's look at what is happening with the large caps and the small caps specifically. About 90% of the large cap funds generated underperformance or negative alpha in that 5-year rolling period analysis that CRISIL did. And what we can see is a similar result for mid caps as well, where there was initially some sort of an underperformance. Over time, alpha does start generating, but as we sort of progress and get closer to 2021, it starts dipping down again. What's happening with the small cap funds? In the small caps, largely speaking, they've managed to outperform the benchmarks with a very small proportion sort of showing negative negative returns in March 2021, probably because of the whole sort of COVID pandemic and various other sort of market related reasons. We've seen how alpha was being generated across large caps, mid caps, and small caps. I think it's time to sort of look at what type of market regimes were we in across those analysis periods, because that would have a massive impact on the performance as well and the alpha generation potential, right? And we speak about market cycles. We're talking about bull phases and bear phases, right? During bull phases, actively managed funds tend to lag behind benchmarks, while during bear phases they do show enhanced outperformance of the benchmarks. So let's say if we look at the large cap funds, we can see an outperformance of the benchmark in 3 out of 5 bull phases and generated alpha in 4 out of 6 of the bear phases. The mid-cap funds gave negative alpha relative to the benchmark in 2 out of 4 of the bull phases, but outperformed in 3 out of the 5 bear phases. Successful identification of alpha needs a strategic approach to differentiate between the potential winners and the losers in the market, and this is something that the small cap funds were really able to do. When we look at it, we see at least in 4 of the bear phases they generated alpha and beat the benchmarks, and delivered positive returns also in bull phases at least 2 out of the 3 times.
We are bombarded by data into the financial markets. There is data every day. There's data in the company financials, there's data in the stock prices, there is data on Twitter, there's data all over the news, right? And the actual ability of a manager to extract actionable insights and actual information from that data is what can lead to outperformance. So now it is very critical for us to understand that is alpha or outperformance in the market a result of just luck, or is it actual skill that leads to alpha generation? There have been quite a few researchers who have investigated ability of managers to generate alpha. First research was done by Pharma and French. They looked at a multi-factor model. Found out was there is negligible alpha out there in the market. The second research was done by Kramers, and what they said is that the active component, or how much a particular portfolio differs from the benchmark, is what is for that particular portfolio. And then research that was done by Amihud, what that says is ability or how different the portfolio's return profile is from the benchmark's return profile. That is a measure that can lead to higher alpha. So what that means is stock selection varying from the benchmark, and the active component is what some researchers have attributed to alpha returns. So alpha generation, is it skill or is it luck? Let's look at an experiment done by a few researchers. So some researchers investigated more than 900 fund performance in the US market and tried to find out statistically if there is actual alpha in the market. What they saw was that the average outperformance of stock returns was the negative of the expense ratio. And if they looked at the random selection, right? So if all portfolios followed a random distribution, there would be certain portfolios that will be expected to fall into the tail end also. And what they found was that there was only a very small percentage, exactly similar to the random distribution, that fell into that high return category. But then they dug a little bit deeper. And after closer investigation into the performance of these particular funds, what they saw was that there is in fact evidence of alpha being dependent on selectivity. So the small set of funds that do actually outperform the market are very, very sensitive to the stock selection. So obviously, these funds are not random, right? These funds actually do perform well. Superior stock selection being done by the particular managers behind these funds. So there is in fact evidence of consistency of alpha generation based on the research done. Closer to home, another study was done by CRISIL to investigate the evidence of alpha. What they did was that on a 5-year rolling basis, they looked at the top performers and the least performers in a given mutual fund category. What they found out was there was a very, very clear alpha that was present between the best performing funds and the least performing funds. What they have also seen is that very recently that alpha has sort of decayed, and the alpha in outperformance of large cap funds has sort of reduced a bit. The smaller funds, you would see that mid caps have a higher alpha generation. So the top performing mid cap funds does much better than the least performing mid cap fund. But that spread has also decreased over time. Talking about the increasing efficiency of the Indian stock market. If you move to small caps, you would see that alpha generation potential is even higher. This disparity between the top performing and the least performing funds in different categories gives us a clear indication of a presence of alpha in the stock market. Now, CRISIL also investigated the impact of the duration of or the holding period of these particular funds on their alpha generation. And what they found out was extremely interesting. So if you look at the alpha generation over a short span of time, in less than 1 year, you would see that 31% of the active funds had a negative alpha, right? They did not outperform. But in the same time, if you go to longer horizons, in 3 to 5 year rolling periods, you would see only 3% of the funds actually underperform. So what that means is that actually that if you want to generate alpha through active investment funds, you have to stay invested in them for the.
Why do most managers don't beat the market? Why are they not able to generate alpha? Well, alpha is abundantly present, as we've sort of seen and sort of analyzed that in the earlier sections of this video. Let's try and understand why exactly investment managers aren't able to find alpha, or it is elusive for most investors as well. There are three challenges that we consider here. The first one is forecasting challenges, the second is overlooking the basics, and the third is looking at your behavioral biases. So let's start with the first one, forecasting challenges. There is an unpredictability of macroeconomic events, geopolitical movements that are happening in the world, trying to anticipate what market event might be happening next, how do investors behave, and a lot of these different types of challenges crop up, which can overwhelm any prediction or any forecasting that you might be doing. And the fundamental point that we're trying to make here is that there is an abundance of information out there. There is information that is freely available. There's data that's available to all of us as investors and investment managers. What we need to do is to distinguish between information that is pertinent and is relevant to your investment decisions, and that which is redundant and can be completely ignored. And the inputs that you're giving to your forecast modeling, right, that is very important, because that will determine what is going to happen tomorrow, what will happen 1 day later, 1 week later, 1 month later, whatever the financial markets might be looking like, and how you can sort of navigate them in this unpredictability. The second challenge is that many investors and many investment managers can tend to overlook the basics. What are the basics? Well, simplify your investment analysis to concentrate on the fundamental characteristics that can align with the historical outperformance that may sometimes get overlooked when we have so much data and analysis and all these sort of very complex analytical models and statistical tools at our disposal, right? The focus cannot be solely on the company's finer details. What is the balance sheet looking like? What is the cash flow looking like? That is important, but what is also important is to see it from a broader lens. What is happening at a holistic level, right? And that sort of comes back to our very earlier point that we were making about investing factors. What are these different factors that could determine the performance and the alpha generation potential of the investment strategy that you're following? And these could be different things, such as momentum factor. You're looking at an earnings momentum, a price momentum. Are there certain value factors that you can consider? Is the quality of the stocks that you're buying at a high level as well? So as human beings, as investors, as investment managers, we are all prone to behavioral biases. We all have them inbuilt in us. It's just a human nature. The important point here is to understand how can you identify what those biases are, and how that can have an impact in your investment analysis and in your investment decision making, right? So let's try and talk about a few of these. For instance, one could be confirmation bias. This is where investors may prioritize information or analysis that correlates or corroborates with something that is pre-existing on your own beliefs or an investment thesis or an ideology that you had, right? Another one is a narrative bias, which is where, let's say, an investor wants to lend credibility to a specific narrative. They have a specific thought or a story in mind, and what they do is to sort of build their investment thesis and their investment decisions around that story that they're trying to put forward. And all of this could come at the expense of critical thinking, objective thinking, trying to think from a data driven and an unbiased perspective, and that is very important.
Now let's talk about another interesting phenomena, which is disappearing alpha. You have found a strategy that has helped you generate alpha, something that has been beating the market consistently. But soon you find out that alpha has started disappearing. So what could be the reason of that disappearance of King Alpha? Due to a few reasons. Number one is that a lot of people start copying that particular strategy, right? Just like arbitrage. If there are too many players who are trying to capture that arbitrage, you will see that opportunity disappears. Similarly, if too many people are copying a strategy, you will see alpha in that strategy disappear. Secondly, once the fund size becomes too large, the cost of investing also becomes higher. So if your manager is not managing those costs well, then the high cost of investing can dampen your alpha. And the third thing and the most important thing that we talk about again and again at Wright Research is market regimes. Your portfolio or your alpha generation strategy might be more suited for a particular type of market. And as soon as that regime changes, you would see that strategy is not working well. So alpha generation can be very, very sensitive to the regime that is there into the market. Alpha decay is something that in fact cannot be avoided. If you have a strategy that is consistently generating alpha, then people are going to copy it. If you have a strategy that is suited for a particular market regime, it will get hit once the market regime changes. So what is most critical for us as investors is to consistently monitor what's happening in the market, look at the different things happening in the market, identify newer opportunities and act on that. So how can you generate alpha consistently? At Wright Research, we have several alpha generating strategies like the alpha prime and momentum that have consistently beaten benchmarks and given alpha returns to our investors. In this noisy world of the markets, things change rapidly. And what is very, very important is for us to be tactical and to evaluate our strategies consistently. We use forecasting models, deep data science-based learning to identify alpha opportunities in the market that lead to these strategies being dynamic, tactical, and being able to identify these alpha generating opportunities consistently. If you want to try alpha generation on your own, there are a few tips coming out from our side. Number one is strategic forecasting. Right? Adopt a probabilistic approach. Don't go by a binary yes or no approach. Apply probabilities to different outcomes. Second is any philosophy that you take, do its sensitivity analysis. Take that out in different scenarios and study how sensitive it is to a particular market scenario. And third thing is use statistical models. Markets are noisy, and it is important for us to look at it from a statistical standpoint instead of a deterministic standpoint. Now the second tip is that focus on the basics. As individual investors, identify a critical set of factors that you put your focus on instead of being, drowned by noise. Use automated tools, use systems to consistently take advantage of the metrics that you have identified and follow a systematic approach. A third tip for you is to mitigate any biases in your investing. Look at the biases that people have and try to contradict them. Sometimes following a contrarian approach can help you, move against the herd and do better. And understanding the biases that can trouble your investing is extremely important when generating alpha. For you is regular rebalancing and regular portfolio and strategy review. Like we said, alpha can decay, things that are working will stop working, market regimes will shift, and you need to adapt to take advantage of those markets. So regularly reviewing and evaluating strategies, looking at other opportunities to generate alpha is extremely important if you want to do that consistently. Alpha generation is extremely difficult. It requires a lot of stock selection, identifying the correct set of investments where we can focus on, and doing it in a very regular fashion. And even still, alpha decay is inevitable. Any competitive edge you might have will disappear. And what is very critical is for you to have a research-driven, data-driven approach and consistently having a focus on evaluating and discovering opportunities. So just like we do it at Wright Research, you will have to consistently create, deploy, monitor, and eventually even remove some of the strategies to be able to consistently generate alpha from the markets. Driven or quant-driven approach, you can evaluate your strategies and what's happening into the market to see what's not working, what's working, and where you need to deploy a correct stock selection to generate alpha from the market. So that was all about alpha generation based on this excellent research done by Siddharth for the Wright Research YouTube channel. If you like this video and if you want to see more such videos, please do like this video. Please do comment on these videos and help us amplify our engagement. Do check out the investment strategies that have in fact generated alpha for our investors on the Wright Research website and see if they suit your portfolios. And do let us know how interesting this video was and want us to talk about next in the comment section below. We'll see you in the next one. Until then, happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Don't forget to